So a lot of people hear about the S-Corp and they don't understand whether or not it's really for them, but they've heard people get some great results with it. Typically when they ask the question of whether or not they should have it, the answer they get is based on their income. And most commonly the answer they get is something along the lines of you should have at least $50,000 in income in order to have an S-Corp. And I'm going to have to disagree with that for a couple of reasons. Number one is context. Is that 50,000 net or 50,000 gross? The S corporation has to do with how you report your income. So if we're talking about the gross income, that's not what you're going to report as taxable income. The net income of the business is what you're going to report as taxable income. But let's even assume that that 50,000 mark is supposed to be for net income. The two most common types of entities you're going to use are either going to be that S-Corp or they're going to be the sole proprietorship. And what determines whether or not one or the other makes sense has less to do with, a particular amount of money that's a minimum and more to do with your circumstances and how you're going to be taking your income from the S corporation if you do have one.
There's no explicit rule in the tax code that says you have to have a certain amount of income in order to have an S corporation. Forming an S corporation is as simple as having a eligible entity, so like maybe a single member LLC, and filing the appropriate form with the IRS to elect to be taxed as an S corporation. If that form is accepted, if you get that letter back from the IRS, which you should if you did things within the deadline, then you're now taxed as an S corporation. That can be done regardless of whether you have, no income or a lot of income or, whatever the case may be. So if anyone tells you that there's some magic number to have an S corporation, I can confirm that is most sincerely not true. There is no magic number. In fact, sometimes an S corporation might make sense for someone if they make less money than it would if they made more money. And that can be in the context of how much they make overall from their business or how much they get from reasonable compensation, which is what I want to talk about next. Now, when we talk about reasonable compensation, what we're actually referring to is the requirement if you own an S corporation, you're an employee of the S corporation as an owner, you're required to take a reasonable compensation through payroll. This is because when you have an S corporation, the distributions you take from the corporation are not subject to self-employment tax. So the way they make up for this is by making you take a salary through the corporation through payroll, and by doing so, you're effectively paying that self-employment tax in the form of both withholdings as well as payroll taxes. So you're paying it no matter what. Obviously, though, only having a portion of your money be subject to that self-employment tax could be a lot better than having all of your money subject to that self-employment tax. And this is one of the things to keep in mind with an S corporation. There's two major drawbacks. One of them is that you have to take that salary and have a payroll company involved, whereas with the sole proprietorship, things are a lot more simple. You don't have to have that. The second consideration is the fact that when you file as a sole proprietorship, your business income gets reported on your personal taxes. There's no separate tax return that has to be filed for it. When you have an S corporation, the corporation itself completes something called an 1120-S, which is a type of corporate tax return. From that 1120-S, you're going to get not just your W-2 from the payroll, but also a K-1 with all your distributions on it. The K-1 doesn't actually reflect the cash distributions you received, but rather it reflects the net profit from the business that's now subject to tax. You're going to put both of these on your 1040, and that's how you're actually going to report your income from the business, both K-1 and W-2. That's where your tax is going to be generated. Now, when it comes to how much you take for reasonable compensation, this is a pretty heavily disputed thing because the actual guidelines for reasonable compensation are extraordinarily long and convoluted, so there's a lot of contention between different accountants as to how much you should take and even whether you should take any at all. I can definitely say that taking a reasonable compensation for most watching this is definitely going to be a requirement. I wouldn't go as far to say as you can get away without taking one. But the amount is going to matter because the amount doesn't just affect how much you pay in self-employment tax through payroll, but this also has an effect on your limitations for qualified business income deduction. And that is where the real line between sole proprietorship and S-Corp is formed. How much you alone take through W-2 can severely limit how much you can take in QBI deduction. So in some cases, it's actually more worthwhile to take the full QBI deduction instead of having it limited by your W-2 wages. But again, this is very circumstantial and depends not just on how much money you make for the company, but how much you take through reasonable compensation. In order to get an accurate reasonable compensation number, we use something called rcreports.com. This is a service that we pay for annually, and it has an algorithm that allows us to get a very specific reasonable compensation number for our clients that's based off of specific IRS guidelines. So this is how we do it, but it doesn't necessarily mean that that's the only way to go about it. I've heard guidelines that say you should take 50-50, half of your money through W-2, half your money through K-1, and then I've heard guidelines that say you should just take $52,000 a year and call it done. But of course, what you do is ultimately up to you, because at the end of the day, you're the one who holds the majority of the responsibility for what goes in your tax return, if not all of the responsibility. So now that we understand that portion of it, we can start to come back to this original question, which is, what really is the minimum income that you need to have in order to have an S corporation? And obviously you don't want to create an S corporation if you're not going to have any taxable income, because all you're doing is creating an extra tax return to do possible extra tax liability with the requirement for reasonable salary. While it is commonly said that the government can't compel a company to pay an owner a salary it can't afford, you don't necessarily want to be walking around with an S corporation if you don't expect to have a net profit in the first few years. But if you are going to have a net profit in those first few years, the question starts to become, well, would you save tax money by switching to an S corporation? And more often than half the time, the answer is going to be yes. I would say at least 60% of cases use S corporations currently when it comes to real estate agents, real estate brokerages, as well as the real estate investors. Now, of course, investors can depend on long-term versus short-term liability, but that's a topic for another video. So when it comes to forming the S corporation, really the only solid advice we can give anyone is consult a professional before you do it. And make sure you understand, what kind of net income do you really expect to have in a given year? Make sure you understand the requirement of filling out that extra tax return every year. And make sure you understand the requirement of taking that reasonable compensation through payroll every year. Because now you're not just talking about paying one tax bill through your tax return, you're going to be paying yourself through payroll, which means you're going to be sending money to the IRS on a regular basis. This can be fantastic for you if you're looking to get some payments in the meantime and you haven't been great at making quarterly payments. But nevertheless, it's an additional liability, an additional cost. And obviously that's going to have an effect on your cash flow, which is why it's important to understand these things before you go in. Don't just create an LLC by yourself and then assume it's going to be a great S corporation. It's important to have both legal counsel and tax counsel when you're creating your business entity, because there's a legal side the lawyer is going to have to advise you on, and then there's a tax side that somebody like me is going to have to advise you on. So you want to have both of those factors. Sure, there might be some instances where an attorney is also very tax savvy, but more often than not, people in a particular field tend to specialize in a particular discipline in that field. If you're focused on law, it's hard to be focused on the tax side of things. That's about going to wrap up this video. I hope this gave you a new perspective on this. It may not have been the cut and dry answer that you're looking for, but it was a truthful answer. If you plan on having a taxable net income every year, then there's a good chance the S corporation might make sense for you. But everyone's case is different, and it's important to understand some additional numbers such as reasonable compensation before you go creating the entity, because that's the only way you're going to know for a fact that it's going to work out well for you. And if you've been having trouble figuring this stuff out for yourself and you want guidance from someone who specializes in the real estate industry, I encourage you to go to realestatetaxplanning.com/book and schedule a free strategy session with us to see if we can help you with your case. That's going to do it for this video. I look forward to seeing you in the next one.